credit card debt? You're not alone. Let's break down two popular strategies to tackle it: credit card refinancing and debt consolidation. First, credit card refinancing means replacing high-interest debt with a new loan or card offering better terms. Think balance transfers to a 0% APR card, ideal if you can pay off the debt fast. Save on interest with 0% intro rates, 6 to 18 months. Simplify payments to one card. Balance transfer fees, 3 to 5% rates spike after the promo period. Debt consolidation combines multiple debts, credit cards, medical bills, loans, into one fixed-rate loan. Perfect for managing large or long-term debt. Pros of consolidation: fixed payments and predictable timeline, potentially lower interest rates. Cons: may require collateral, e.g., home equity, longer repayment terms. Choose refinancing if you have good credit and can clear debt quickly. Opt for consolidation if you need structure for multiple debts or a longer payoff window. Whichever path you take, avoid new debt and stick to your plan. Ready to take control? Calculate your savings and consult a financial advisor. Like and share. Thank you for watching.